Are you struggling to manage risk in options trading or knowing when to take profit? I see a lot of traders will rely on arbitrary stop loss percentages or take profit percentages, and they end up losing more than they should, or don't protect their capital in the way they should, or they're just kind of spinning their tires and not really getting anywhere in their account. I'm going to show you a couple different ways to position your risk in your trades and learn how to exponentially bet size to get better gains and results. The first things first is knowing the different ways to size your trades. There's position sizing and then there's stop sizing. This is how I personally categorize the different ways of sizing trades, whereas a lot of traders will, have these arbitrary percentages that are stop loss at say 20%, take profit 20%, and 40%, 60%, so on and so forth. One thing that's really key and a good principle to understand is, while there are strategies that can work with this in mind, but it's important to understand fundamentally what your trades are and relate the way that you size, the way that you, based off of what the chart is actually doing. So you want to follow price action first before anything else. And sometimes that might mean on a certain stock that's more volatile that you're risking 50%, not 20%, to be realistic. So using arbitrary percentage is something I don't like to do. There are other strategies that may work with this, but specific to day trading, I've found a lot more success just focusing on the chart and positioning around that. With that being said, there are a couple different ways to trade. And I see a lot of traders get hung up wanting to have one universal or global kind of rule for how they treat everything. And that just simply doesn't work, because not every trade is the same and the market's not always the same. So how do I approach this? Well, let's dive into the two main ways and how I size trades and what that means. So position sizing first just simply means if you're going to risk $500 in a trade, you buy $500 worth of options. This is kind of at the very core nature of options, and one of the biggest incentives of options products is the fact that you can define your risk, and then you can scale up from there. Maybe you take a little bit more with better trades or more confident trades. Maybe you grade them A, B, or C like we do, and so on and so forth. And then as you get better, your account will ideally scale with time. Stop sizing, on the other hand, means that you're positioning your size in the trade based off of the price action. So say a stock is trading at 100 and your stop is 98, you're doing the math on how much the options would decay into that stop and then sizing accordingly. So let's go through a couple examples of when using these different kinds of sizing methods would play out, and then we're going to talk about different ways or different bet models. So we're going to talk about equal bet sizing, linear bet sizing, exponential bet sizing, and the differences in results in the account and where most traders are kind of stuck. So first, an example of position sizing. A couple different ways that you can use position sizing, or where it can make sense rather, is either trading just based off of a simple idea, so a thesis. So you might have a thesis or an idea that you're trading based off of. You also might have overnight risk. So maybe there's a trade that you want to hold overnight, or you're swing trading and you need to make sure you're accounting for that risk, so you position size for it. Or it's just a volatile name. Sometimes there are stocks that are moving quite crazy, maybe very volatile, or they're a squeeze play, sometimes biotech, something like this that is abnormal. It can make more sense to trade the options because your risk is defined. So these are a couple different areas or situations rather that position sizing makes sense. So in this example on Meta, I'm just going to talk through a position size that I put on, or a trade where I just risked what I was willing to lose in the trade because it was based off an idea. And this will make more sense when we go over the contrary, which is stop sizing, which is better for day trades, momentum trade, and things like that, or even asymmetric risk reward opportunities, which is a key in my room that we talk about a lot into unlocking account growth without increasing risk. But first, let's go through the Meta example of position sizing. So I had a very simple idea here. Meta was trading, it had previously broken out over its all-time highs, and then it had just been kind of in this upward channel while the market was also trending higher. So on the first, we saw Meta break out over the highs and then fail. It couldn't sustain the all-time high breakout and the market wasn't quite ready. Then the next day had a small range day. It managed to hold this trend, and then going into the next day, this being a market leader, my idea was very simple, super simple, in the fact that being a market leader, if the market can break out, then Meta can lead. Really easy thesis. Doesn't take a rocket scientist to figure that out. So rather than day trading this, I just had an idea that if the market goes higher, which it did, then I'm going to put on a certain amount of risk with enough time to where I can just see it play out. So in this scenario, buying maybe a couple weeks out on options, I bought 2 weeks out on options. Let's say you're willing to risk $1,000 in the trade. You just buy $1,000 worth of options. You can still have a trade plan where you have a stop and some take profits. In this case, I was risking just that day's low at 568. I entered around 575, 576, and my thesis was very simple. If it can get a breakout on the second attempt, I think it can get to 600. Very straightforward. And rather than trying to have a tight stop, I would rather just be invested in it and be positioned, which is why I call it position sizing, for that move to 600. And this played out really nicely. Obviously, they don't always play out. And if this is important, if your stop does hit, you can still take it out. So say, you're down 60 or 70% at this point. If your idea is invalidated, you should still honor your stops, and you're just mitigating some risk in the long term or in the aggregate, over 100 trades. If you stop, rather than letting it go to zero, you're just kind of, saving yourself some money there. So what would be the polar opposite? Well, more common for me personally, and more day trades would be stop sizing. And there's a couple things or scenarios where this can apply. So stop sizing, this was a trade that we took today on TSM. So it's going to apply to more momentum based trades, and it does require more discipline because your risks are going to be higher if you're not disciplined. Your risk won't increase if you do what your plan is. So let's go through why that's the case. So on TSM, we're looking at an opening drive trade today. Our typical entry would be through the pre-market highs, which didn't quite break on the first attempt. And then we came down into this 202 level. We're like, oh, okay, well, if this holds, which it did, and starts to turn higher, whether you enter early on the turn, which is something that I did, or even wait for the pre-market high to break, instead of using, down here, or just position sizing and say, okay, well, I think TSM can go up on this trade. I risk $1,000 on every single trade, and that's what I do. Well, what if you can manage and calculate your risk at 202 and take double the size, but still risk the same? So in this case, just for the sake of example, let's say that this was a 50% drawdown if you entered on the break of the pre-market highs. If it were to drop to this 202 level, you lose 50%. Well, you can take $2,000 of a position and still risk the same amount, but you're making exponentially more if trade works. So that's an example of stop sizing, and I typically will do this on most of my day trades. And if you struggle calculating, there's a couple tips that I have. You can use different tools or websites. If you need help finding one, let me know. Drop a comment or shoot me a DM on Discord. I can point you in the right direction. Over time, you will get very well versed in how options move and can quickly calculate within at least 5 or 10%. I've rarely ever struggled with doing so. Before we move on, I do want to just touch on, before we get into different bet sizing and different models that you can take towards how you bet and risk to grow your account, one key unlock that I think is extremely undervalued, or something I haven't heard a lot of people talk about, is asymmetric risk reward opportunities. So using stop sizing, there are times where in your best trades, and this is a great example of one of our best trades, this is a top op that we logged in our database today after stream, is when you have a situation set up within your top op or spec setup that offers really unique risk reward. And so typically on a trade like this, we're going to enter through the pre-market highs, so here, which is where we did enter today. But if you're aware and see another entry briefly mentioned, we had a really nice turn, is what we like to define this move, where price tests support and then turns off of it. So this is very straightforward, because the rest, and the main caveat with this is it's not random. This is a setup that we trade. This is our top trade setup we look for every single day. So this isn't random. This isn't just a stock that's testing a random support level and we're applying this concept on. So don't get it misconstrued. Make sure that if you are applying or trying this concept out, it really resonates and is fitting within your top opportunities that you have seen over and over again. So this is not necessarily for a beginner, but it's something to look forward to as you grow. So as the price begins to turn off, you have a really unique risk reward scenario. This allowed me to profit about double what I normally would have on this trade. I did enter through the pre-market highs, but anyways, as I saw this turn off of support, roughly $1.50 of risk, and in the options that equated to, on weeklies, about 15%. They were pretty volatile. On next week's options is about 10% or so, give or take. So say 20%, just to be more conservative. You're risking 20%. Well, these options into this move paid nearly 100%. You got very close to 100% on this move. So you're risking a very small amount. Say that you take $10,000 worth of size, you're only risking about $2,000 in the trade. But if you're taking $10,000 worth of size and this goes 100% and you're making $10,000 in a trade, you're exponentially increasing your reward. You're making, well beyond, over 5 times beyond what you typically would make in a normal trade. If say your position size is normally 2,000. So say normally you just take 2,000. You're like, oh, I like the turn entry, I'm going to take $2,000 worth of size here. It's like, okay, cool. If it works, then you make $2,000. But if you're able to stop size, then you're significantly increasing your gains, which is why I call it, an asymmetric risk reward opportunity, where you can unlock exponential gains without having to exponentially increase your risk. So anyways, you'll see how that is important when growing an account once we get into the next step, which is the different ways you can decide to bet size to grow your account. All right, so what are the different ways that you can bet in your trades or risk? So most traders will start with equal bet sizing. So equal bet sizing is really simple, say 500, 500, 500. We can assume a couple things here. Let's say that, this is A setup, and then we have a B setup and a C setup. So say we have A, B, and C sizing, and then you have linear bet sizing, 1K, 2K, 3K size per trade. And we're just assuming that you're grading your trades. Exponential bet size would be something like 1K, 3K, and then even like pushing it up to 6K. These are the different types of ways that you can approach your different sizing. I notice a lot of newer traders will kind of gravitate toward equal bet sizing. They'll say, I'm going to risk $500 per trade. And let's just go through what the results of these typically look like. So, in this first example, equal bet sizing usually results in something that looks like this. In terms of an equity curve or P&L curve, you usually get something where it's like really just spinning your tires and not going anywhere. And human nature comes in, you're still learning, you have a mistake that comes in, you grind your way back up, and you're kind of just going up and down and nowhere. That's usually what the result of this equal bet sizing is. And then linear bet sizing usually a little bit better, which is where I would say intermediate traders typically land. You have something where you're kind of battling and you start to trend higher, and overall over time you're trending higher, and everything is looking pretty good if you have edge. And then there's exponential bet sizing, which kind of break out the curve where you have something like this. And actually I will pull in an example and just show you my equity curve. This is a concept that has really worked well for me. So I used to start out just like everybody else, equal bet sizing, learning how to trade, so on and so forth. And then as I became more experienced, I began to introduce more linear bet sizing. And then once I got very experienced and more advanced, I realized that the difference in trading is exponential bet sizing. I cover some important topics in my other full guide that talks about becoming fully, or how to become consistently profitable, like determining your edge and so on and so forth. Once you get to that point where you are confident in your playbook and what you're doing, it becomes much easier to exponential bet size. So I don't recommend starting out here, but you can kind of see how the impact can be on your account. And this is really what trading is about. This is where you want to get to as a trader. It's getting to the point where you have enough reps and experience in your trades where you can exponential bet size. And it's just the way that the math works out. If you are taking a large majority of C trades and risking $500 per trade, in the aggregate, you're probably going to wash out and not really make much money. The house is probably going to win. In the example of linear bet sizing, you're probably going to take less A trades, a decent amount of B trades, and a decent amount of C trades, and you'll probably make some money and do fairly well if you have a strong strategy. But exponential bet sizing is where even if you're taking significantly less A trades, the way that the math works, you're going to make substantially more money. It's going to cover the cost of the majority of your trades. The majority of your trades that don't go well, or there's going to be a lot of C trades. You're going to see a lot more volume of C trades, a lot more volume of B trades. A trades are going to be more rare, but they're going to cover the majority of your gains. And you can see just from looking at my P&L graph that is the case. I don't have as many A opportunities that might come up, but by introducing exponential bet sizing to my strategy, it's really making a strong difference in the P&L. So I could take 20, 30 C trades, 10 B trades, and this isn't going to really impact my P&L too much. It's really the A trades that are going to make a big difference. And you can kind of see my journey of linear bet sizing. This is what a typical journey of linear bet sizing looks like. You go through nice streaks, some pullbacks, downtrends, and consolidation phases, breakouts, maybe some mistakes. I think this is about where I started to introduce some exponential bet sizing into my strategy, and then that combination started to really play out well. So to wrap things up, the differences between position sizing and stop sizing has really helped me apply the risk to the scenario that I'm in. If I'm day trading or in a momentum trade, I'm going to be more inclined to focus on stop sizing. If I have a more of an idea or thesis, I'm going to be focused more so on position sizing. And generally in your A trades, bigger opportunities, you're going to be focused more on stop sizing. So the bottom line is successfully trading options requires understanding your risk, choosing the right risk model based on the setup that's right in front of you. Do this based off the chart, not just arbitrary percentages, so you're making informed decisions that align with your strategy or thesis in a specific trade. Look to use and leverage options with stop sizing in your best trades when there's a clearly defined risk reward element present, and know the math. So if you're newer to trading, equal bet sizing with very small amounts just to get reps and learn how to trade. There's nothing wrong with that. As you begin to progress your playbook and really gain confidence in the market, begin thinking about introducing bet sizing. Whether you're position sizing or stop sizing, the total risk that you assume in a trade, getting to a linear bet sizing model as you become more confident is great. And then once you begin to gain confidence in your data and have a lot of experience, then you can start to introduce exponential bet sizing and really see a difference in your account growth.